Welcome to the Byte-Size Brief. Today, we are putting Eversource Energy, that's ES, completely under the microscope. Let's get into it.
Yeah, I'm really excited to dig into this one.
Because, for those of you tuning in to our deep dive format, we absolutely love a good corporate turnaround story.
Oh, definitely.
And what a fascinating time to be looking at this specific company. Over the past year, Eversource Energy, ticker ES, has delivered this just massive 30% total shareholder return.
Which is huge.
Right. In the utility sector, where, people usually invest just for those slow, sleepy dividends, a 30% run is phenomenal.
It's basically unheard of for a regulated utility.
Exactly. But if you look at just the last month, the stock has cooled off quite a bit. It dropped about 5% and settled in around that $69.97 mark.
Yeah, the momentum definitely shifted.
So our mission today is to figure out what is really going on under the hood here. They are executing this massive strategic pivot completely ditching their offshore wind projects to become a pure-play regulated grid operator.
Right. Stripping it down to the core business.
Yeah. And we want to know, is this recent dip a prime buying opportunity for yield-hungry investors, or is it a warning sign of deeper structural issues?
Well, it is the defining question for the stock right now. Without a doubt.
Absolutely.
Because on the surface, you have this very attractive 4.5% dividend yield. And that immediately catches the eye of income investors.
Oh, yeah. 4.5% is nothing to sneeze at.
Right. But as we peel back the layers, this company is currently navigating an absolute minefield of regulatory shifts across New England.
It's a tough environment up there right now.
It really is. And they are also carrying very high debt levels. We're talking about a debt-to-equity ratio of 184.2%.
Wow, that is steep.
Yeah. Now, in the utility sector, high debt is common, but that level leaves very little margin for error. On top of all that, management just rolled out an enormous $26.5 billion capital expenditure plan for the next 5 years.
Wait, $26 billion?
$26.5 billion, yeah. And that kind of spending demands flawless execution and, crucially, cooperative regulators. If they stumble, the financial strain could be severe.
I completely agree. The stakes are incredibly high right now. And while a 30% run over 12 months looks great on a chart, that recent 5% drop isn't just random market noise.
No, it's a very specific reaction.
To understand why the stock has stumbled recently, we really have to look at a major regulatory curveball that was thrown at them just days ago.
Yeah, the FERC ruling.
Right. Let's get right into the catalyst. Walk us through exactly what happened with the regulators in April 2026, because it fundamentally changes the math for their transmission business.
It absolutely does. So the catalyst was a significant ruling from FERC, that's the Federal Energy Regulatory Commission.
Mm-hmm.
They are the federal body that regulates the transmission of electricity across state lines. And in early April, FERC issued a decision that cut the allowed return on equity, or ROE, for New England transmission owners.
By how much?
They dropped it from 10.57% down to 9.57%.
So basically, it's kind of like your boss suddenly deciding to cut your guaranteed bonus by 10% just because they can. Hold on. How does that actually affect Eversource Energy, ES's stock price for regular investors like me?
That toll road, or bonus analogy, perfectly captures the mechanism of regulated utilities.
Right.
They don't make a markup on the electricity itself.
Right.
They make a guaranteed return on the infrastructure they build. And to answer your question about the stock price, this ROE cut hits their bottom line directly and, well, immediately.
Ow.
Because Eversource Energy, ES, operates one of the largest transmission networks across New England. So that 100 basis point drop, that 1% reduction in their allowed return shaves approximately $70 million right off their 2026 after-tax earnings.
$70 million, just gone.
That is real cash flow vanishing into thin air. And because of this, we immediately saw major institutions react. Analysts at Wells Fargo and Bank of America both trimmed their price targets for the stock following the FERC ruling.
Yeah, that makes sense.
It forces the entire market to reevaluate the company's near-term earning power.
Wow, $70 million just wiped off the board with the stroke of a regulator's pen. That certainly explains the 5% drop over the last month.
Yeah, it was a heavy hit.
But what fascinates me as we look at the analyst notes is how totally divided the market is on what this means for the valuation. There's like a real tug of war happening right now between different financial models.
There is a massive divergence in how the street is valuing this company right now. We are essentially looking at two very distinct market narratives.
Okay, break them down for us.
On one side, you have the consensus analyst view. This group looks at the core business, the reliability of the dividend, and the sheer size of their upcoming regulated grid investments.
And what do they say?
They conclude that the stock is still about 4.4% undervalued. They've pinned a fair value target near $73.15 per share.
Gotcha.
Their argument is that Eversource Energy, ES, will eventually outgrow this FERC penalty just by aggressively building out more grid infrastructure.
Right, but I know consensus targets can sometimes be a bit, overly optimistic because they rely heavily on management's long-term growth promises.
That's a very fair critique.
Then you look at the other side of the valuation coin, which is much more rigid.
Exactly. The other side relies on a discounted cash flow, or DCF, model. This is a strict mathematical approach that values a company based purely on the present value of the actual cash it's expected to generate in the future.
The hard numbers.
Right, and the DCF model paints a much bleaker picture. It prices those future cash flows at roughly $57.71 per share.
Oh, wow, that's way lower.
Yeah, from a pure cash generation standpoint, the stock actually screens as overvalued at its current price, near $70.
Interesting.
The DCF model is punishing them right now because they are spending massive amounts of cash on infrastructure, but their ability to generate immediate cash returns is being constrained by regulatory caps like that FERC decision.
That is a massive gap, $73 versus $57. With those valuation models pulling in such totally different directions, we really need to look at how the core business is actually performing right now to see if they can absorb this regulatory hit.
Okay, so compared to last quarter, what actually moved the needle here?
Well, the most recent data we have is from their Q4 2025 earnings report. And honestly, from an operational standpoint, it was a very strong beat.
Real?
Yeah, revenue came in at $3.37 billion, which was up 13.4% year over year.
13%, that's solid.
It absolutely crushed the consensus estimate of $2.94 billion. And this wasn't just some accounting trick. It was driven by their previous capital investments finally being recognized in their rate base.
So the investments are paying off. Exactly, combined with incredibly resilient underlying power demand in New England, especially in the tech and life science corridors up there.
Right, all those labs and data centers need juice.
You got it. Earnings per share, or EPS, hit $1.12, beating the $1.10 estimate. And for the full year, their non-GAAP EPS landed solidly at $4.76.
That's a great quarter. But as a retail investor looking at their forward projections, this is where the math kind of stops making sense to me.
Where's the disconnect?
If Q4 was such a blowout and revenue is up double digits, why on earth is their full year 2026 EPS guidance only set at $4.80 to $4.95?
Ah, yes. The 2026 guidance.
I mean, if they did $4.76 last year, a target of $4.80 is practically flat. That is incredibly sluggish growth for a company that is successfully deploying billions into the grid.
It is sluggish, and management is acutely aware of how that looks to the street. In their earnings call, they explicitly referred to 2026 as a transitory year.
A transitory year?
Yeah, you essentially have an earnings air pocket right now. The FERC ROE cuts we just talked about are dragging down the 2026 numbers immediately.
Oh, right, that $70 million hit.
Exactly.
Right.
Plus, utilities suffer from what we call regulatory lag. They are currently in a holding pattern, waiting for several new rate case approvals to take effect in their state jurisdictions.
So they're spending but not earning on it yet.
Exactly. They are spending the money now to modernize the grid, but without those new higher rates approved by the states, their revenue growth stalls out temporarily.
So 2026 is basically a gap year. They just have to survive it, keep the lights on, and wait for the regulatory machinery to catch up to their spending.
Precisely. But management is actively telling investors to look past the 2026 air pocket. They are hyper-focused on 2027 and 2028.
Looking ahead to the payoff.
Right, because once these new rates finally kick in, they are targeting a 5% to 7% long-term EPS growth rate. And importantly, they aren't just sitting idle while they wait for the regulators.
What are they doing in the meantime?
They are actively repairing their balance sheet. Over the trailing 12 months, ending in late 2025, they managed to improve their FFO to debt metric by a crucial 400 basis points.
Let's break that metric down because FFO to debt, which is funds from operations to debt, is something credit rating agencies just obsess over.
They really do.
It basically measures how much pure operating cash a company generates relative to its total debt load. If that ratio drops too low, credit agencies like Moody's will downgrade your debt.
And that is a huge problem.
Exactly, your borrowing costs spike. And for a utility planning to borrow and spend $26.5 billion, a credit downgrade is a death sentence. So improving that by 400 basis points is a massive win.
It is the ultimate defensive maneuver. They are padding their financial armor right now. But to survive this transitory 2026 and to fund their future growth without triggering that exact credit downgrade you mentioned, Eversource Energy, ES, has to sell off its non-core assets.
They need cash now.
They need cash now, which means trimming the fat. And the biggest piece of fat was their offshore wind portfolio.
The offshore wind exit is arguably the most critical part of the Eversource Energy ES turnaround story. I mean, for years, these wind projects were plagued by supply chain chaos, material inflation, and regulatory delays.
It was a mess.
The whole sector essentially collapsed under its own weight, and it became a massive overhang on the stock. But they are finally nearing the finish line of their exit, right?
They are. The major remaining piece is the Revolution Wind project. It is currently 87% complete and is scheduled to hit its commercial operation date, or SCOT-out, in the second half of 2026.
Okay, so almost there.
Yeah, and to finally extract themselves from this sector, they struck a deal to sell their wind stakes to Global Infrastructure Partners, or GIP.
Right.
But to walk away clean, Eversource Energy, ES, had to absorb a significant final blow. In Q3 of 2025, they took a $75 million charge to officially cap their future liabilities to GIP.
So basically, it's kind of like paying off a toxic, high-interest credit card and finally cutting it up so it can't drag down your credit score anymore.
That's a great way to put it. They were trapped in fixed-price power purchase agreements, while their construction costs just skyrocketed due to inflation.
A total nightmare scenario.
Exactly. So by taking that $75 million loss, they permanently closed the door on any future surprise costs from that sector. The market hates uncertainty more than anything else.
Absolutely.
By capping that liability, they removed a massive dark cloud that was hovering over those DCF valuation models we discussed earlier.
But the wind exit is really only half the story when it comes to raising cash. We have to talk about the Aquarion Water Company saga, which has been an absolute roller coaster for shareholders.
Oh, definitely a roller coaster.
Eversource struck a deal to sell Aquarion to the Regional Water Authority for $2.4 billion. But then, in November 2025, Connecticut's regulator PURA shockingly blocked the sale.
Yeah, that caught everyone off guard.
I remember the stock tanking nearly 10% on that news alone because PURA essentially said the sale wasn't in the public interest. That was a massive red flag for regulatory hostility.
It was a huge shock to the market, and it deeply rattled investor confidence in the Connecticut regulatory environment. But, the story didn't end there.
Right.
The case went to court, was remanded back to the regulator, and as of March 2026, PURA has finally given a conditional approval for the sale. The deal is back on track.
I think a lot of everyday investors might look at that headline and ask, why does a water company matter so much to someone investing in an electric utility? And the answer, as you pointed out, is pure, unadulterated cash flow.
Exactly. Eversource Energy, ES, desperately needs the $1.6 billion in net cash that this water sale will generate.
They need the cash.
Without that cash infusion, the math for their entire business plan breaks down. Management was very clear about the alternative. If the deal were to fall through permanently, they would be forced to issue between $800 million and $1.1 billion in junior subordinated debt or straight equity.
Let's unpack that, because neither of those options are good for current investors. Junior subordinated debt is debt that sits at the very bottom of the priority list if a company goes bankrupt.
It's extremely risky for the lender.
Right. And because it's much riskier, it carries a painfully high interest rate, which would just bleed their future earnings. And issuing straight equity is even worse. It means creating millions of new shares, which dilutes the value of every existing share and reduces the earnings per share.
Exactly. It would structurally damage the value of the stock.
Yeah.
So getting that $1.6 billion in cash is an existential priority.
They had to get it done.
And they actually played a bit of hardball to force the issue with PURA. As a backup plan, if the regulator permanently killed the sale, The company formally submitted a notice that they would immediately file an $88 million rate case for Aquarion.
Wow.
Because they are legally entitled to earn a return on their assets, they essentially threatened to raise water rates significantly for everyday consumers if they weren't allowed to sell the company.
Let us sell it, or your constituents pay the price. That is an aggressive, high-stakes move.
It is.
But clearly, the pressure campaign worked since the conditional approval just came through. So, assuming they successfully exit wind and finally get the $1.6 billion in cash for the water company, where exactly is Eversource Energy, ES, putting all of its chips?
They're pushing all their chips to the center of the table on the grid itself. Specifically, a massive 5-year, $26.5 billion capital investment plan.
$26.5 billion.
To put that in perspective, that is an increase of $2.3 billion from their previous 5-year plan.
That is an astronomical amount of money. Where exactly is $26 billion going?
Well, a huge portion is going toward modernizing and hardening the electric distribution networks. A prime example is the Cambridge Underground substation.
The underground one?
Yeah, at $1.8 billion, it will be the largest underground substation in the entire nation. And Cambridge is incredibly dense. Securing land is nearly impossible, and the power demand from the booming commercial real estate and biotech sectors there is just surging. Building a substation underground requires massive civil engineering, advanced cooling systems, and specialized equipment.
Which explains the staggering price tag.
Exactly, but it is entirely necessary to support the local economy. Beyond heavy infrastructure, they're also rolling out advanced metering infrastructure, or AMI smart meters. They have already installed over 100,000 of them in Massachusetts alone.
And those smart meters are crucial because they actually generate a return on investment through operational efficiency.
You do.
They eliminate the need for trucks to drive around manually reading meters, and they enable time-of-use pricing, which encourages customers to use power during off-peak hours.
It's all about load management.
Exactly. That shaves the peak load off the grid and reduces the need to fire up expensive, highly polluting peaker power plants. Modernizing the grid sounds fantastic. Everyone wants a smart, resilient power grid. But Eversource Energy, ES, just sparked a massive political fight in Connecticut over how these green initiatives are actually funded.
Yes, the tension in Connecticut is incredibly thick right now. In April 2026, just recently, the company abruptly backed out of 3 state-supported solar projects in Connecticut, totaling 54 megawatts.
Just walked away.
And they didn't just quietly walk away. Their deputy general counsel sent a highly critical letter to state officials. They flat out said the $238 million price tag over 20 years was over market, and that entering into these contracts would directly harm customer affordability.
Wow.
They essentially accused the state of pushing expensive green projects without a comprehensive, cost-effective energy strategy.
It was a very public, very pointed rejection of the state's clean energy procurement process, especially when you see competitors like National Grid aggressively pushing into similar green initiatives in neighboring states. Hold on, how does that actually affect Eversource Energy, ES's stock price for regular investors like me? Are they just playing hardball?
They are playing a very calculated game of political leverage. To understand why, you have to look at the broader regulatory timeline.
Okay.
Eversource Energy, ES, is currently waiting for a massive make-or-break regulatory decision from Connecticut's PURA in July 2026. They are seeking to recover up to $1.5 billion in deferred storm recovery costs through a financial mechanism called securitization.
Let's explain securitization because this is the key to their entire balance sheet repair. Eversource spent $1.5 billion fixing power lines and restoring power after severe storms. Right.
Regulators agreed the utility should be paid back, but instead of trickling that repayment in over 10 years through tiny rate hikes, securitization allows the utility to issue special bonds backed by a dedicated, non-bypassable charge on customer bills.
Exactly.
Investors buy those bonds, and Eversource gets a massive $1.5 billion lump sum of cash up front right now to pay down their corporate debt. Then the ratepayers slowly pay off the bondholders over time. It is financial engineering that saves the utility's balance sheet without crushing the ratepayer all at once.
Exactly. It transfers the debt off Eversource's books and dramatically improves their financial health. But PURA has to approve it. Ah, there's the catch.
Right. So by publicly rejecting those expensive state solar contracts under the banner of protecting ratepayers from high bills, the company is manufacturing political goodwill.
I see.
They are actively demonstrating to the public that they are the ones fighting for affordability. This puts immense political pressure on PURA to approve their grid-hardening investments and, crucially, that $1.5 billion storm recovery securitization in July.
It's a brilliant strategic move, but it highlights the central risk for the company right now. They have a $26.5 billion capital plan, but they're entirely dependent on state regulators, allowing them to actually earn a return on those investments.
That is the core risk. If the political environment turns hostile and regulators refuse to raise rates, that massive capital plan becomes a financial anchor rather than an engine for growth.
Which brings us to the ultimate paradox facing not just Eversource Energy, ES, but the entire utility sector today. What's the paradox?
On one hand, society is demanding a carbon-free, storm-proof, fully modernized smart grid. We want mass adoption of electric vehicles, we want residential heat pumps, and we want the lights to stay on during a Category 3 hurricane.
Yeah, we want it all.
But on the other hand, absolutely nobody wants their monthly electric bill to go up to pay for it.
Not a single cent.
Exactly. But building the grid of the future requires immense amounts of upfront capital. If regulators continue to cap returns, like we saw with the FERC ROE decision, and block rate increases just to keep voters happy in the short term, who actually funds the multi-billion-dollar energy transition?
That's a huge problem.
Can pure-play utilities actually balance clean energy mandates with the shareholder returns necessary to raise capital in the public markets? If the math doesn't work for investors, the capital dries up, the infrastructure ages, and the grid doesn't get built.
It is a massive societal question, and we are watching the financial realities of it play out in real time with this stock. All right, listeners, what's your take on the future of Eversource Energy, ENS? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Bite-Size Brief.